Measuring, what actually requires measurement? Now, I personally believe there are several important factors that you need to know in order to become buyer ready, particularly when it's regarding finances. Now, Google is a pretty marvelous tool, and there are an amazing amount of free tools that are available on the web to help you clarify where your current standings are. So there's a number of tools that I would recommend that you use or give preferential treatment to over the others. And I've condensed all of such on the next slide, which we'll bring up here. Not the best looking slide, but these are the ones that I would certainly look at, particularly if you were wanting to reduce your debt. The Commonwealth Bank has some great personal loan calculators that I would recommend having a look at. MoneySmart, which is a government website, it's a great actually initiative from the government. So if you don't know of the MoneySmart website, I would strongly recommend that you actually bookmark that site in particular. And the next one of which is RateSetter. And I personally believe from the comparison sites that are available, it's definitely one of the better ones. Get an understanding of what your interest payments are and make some comparisons. See what other products are available. Be mindful to check the exit fees that could be associated with the transfer of products, but there's deals to be had. The next lot of websites I would recommend, particularly around savings, is again, check out the MoneySmart website. There's some great tools and resources and calculators that can be used there. And it's a good tool to use to work out how long it could actually take to build that nest egg. Again, the Commonwealth Bank has a great budgeting and planning tool that could be used. It's a pretty basic calculator. It's actually very similar to all the others, except CommBank has presented the information in a much more user-friendly format, I found. And HSBC, again, they've got some great saving calculators and budget planners. So they've got some handy tools that you can punch in to get some quick estimates against your budget. Now for borrowing, there's a stack of different mortgage calculators out there. And there's a few important things that we really need to discuss around borrowing. Because there's a couple of points that will limit your ability to borrow money. So two websites that I would recommend to check out. One is Mortgage Choice. They've got some good borrowing calculators on there, and also the ANZ Bank. Now, I have to say that I don't have any affiliation to any of these websites whatsoever. I do work with ANZ, and I am an accredited to represent them and their loan products, but along with Commonwealth Bank, but I don't have any affiliations with them outside of that. So when it comes to borrowing, how much you can borrow is very much dependent on your ability to actually service the loan, and that would be represented by the loan to value ratio, or the LVR. Now the LVR aspect is particularly important, as the LVR is the amount of money borrowed against the value of the property. Now, there are loan products that are available that will virtually allow you to borrow 100% of the property value. Strings are going to be attached in these situations, but it's not unheard of people to, secure finance at 95, 90, 85%, etc. Now, as a rule of thumb, 80% is the guideline for the LVR rate. And it's a guideline because having an LVR below 80% means that you'll actually avoid lender's mortgage insurance, or LMI. Now, it can definitely be considered a way of getting into the property market earlier in terms of paying the expense of lender's mortgage insurance. But, be mindful, it's another burden cost that you're going to have to wear. Most importantly, don't get things confused around this, because it can be a common mistake that people make. Lender's mortgage insurance actually protects the lender, not the borrower. This means that the lender will charge you additional money to ensure the lender to insure the lender against, beg your pardon, the risk of borrowing or defaulting on the loan. It's pretty tricky, isn't it? So lenders will basically offer this product because it allows them to offer loans to a broader base of customers. Look, this additional cost could be paid up front or it could be capitalized, meaning that it's added to the total cost of the loan. And lenders will apply for lenders' mortgage insurance on their behalf, and GST is going to be added on top of this as well. Now, if you do default on the loan and the property is sold for a lower value than the initial loan, the insurer is going to make up the difference that's going to be payable to the bank. At that point in time, the insurer may ask you, as the borrower, to repay this sum directly to them. Now, mortgage protection insurance is available to help, insure you in the event that something should prevent you from meeting your commitments. For example, if you were to become ill or suffer from an accident, perhaps. There's many different variations that are offered around this, and it's something to consider, particularly if you have a family and dependents as well. So look, in summary, if you're borrowing more than 80%, it could be costly and it could also be a risky consideration. On the other hand, it could also be viewed as a necessary and worthwhile evil in order to get into the property market sooner. However, to avoid lender's mortgage insurance, you will need to save at least a 20% deposit. Perhaps another alternative could be to ask a close family member to act as guarantor. Some lenders will actually allow you to use your home buyer's grant as part of the deposit. Some will look at your genuine savings history as part of rental repayments. So there are some considerations. Also, certain professions, on the basis of their future earning capacities, can be precluded from lenders' mortgage insurance. People within the medical field, some people within the legal fraternity as well may be exempt because of that future earning capacity. But look, if you're actually looking just out of curiosity's sake, there's thousands of different online calculators to look at. So go in there and crunch some numbers and, plan out what's going to be the most appropriate for you. Maintaining this. So what do I really mean by maintain? Well, firstly, I think you need to look at resources and perhaps some assistance that is available to you. Now, there are a lot of people, businesses, and also financial institutions that are out there that will be more than willing to help. The common theme, though, is that their help will come at some sort of price. So now, sometimes you do have to pay a little to get a better return, and that's fine. Other times, the deal can be loaded with temptation and a lot of potential traps, let alone additional fees and charges. So, in essence, be careful. Again, read the contract, and if you don't understand, seek an alternative opinion, or perhaps even sleep on it before making a decision. If you then feel it stacks up or weighs up and it's going to work for you, well, you should do it. But like all things in life, if it's not going to be suited to you, you should definitely keep walking. So some sites that I recommend are definitely worth checking out. One is obviously the MoneySmart website, which I've previously mentioned, which is moneysmart.gov.au. Simplesavings.com.au is another pretty cool site to check out. Now, if you do fall into some financial hardship, a couple of sites to look at would be financialcounselling.australia.org.au or debtselfhelp.org.au. Those sites are really no-fuss sources of information. But look, if you do a simple Google search, a lot of information will come up about debt management service providers. Again, fees and charges will apply. But if they do get you on track, well then, it might just be the encouragement that you need. If you're genuinely experiencing hardship, though, don't delay it. Get on the phone or go see your lenders or your service providers, whether it be the phone company, electricity, gas, water, whatever it is. Explain your circumstances and work with them to devise an alternate payment structure. It's actually a legal requirement for providers to develop an alternate payment structure should you be experiencing hardship. Now, differing or reducing the repayments or altering the loan repayment term could potentially be arranged. Now, don't delay, because the sooner you actually address your debt problem, the more options will be available. Another good website to reference is doingittough.info. Now, that site provides some tips and also helps identify when you're experiencing hardship. Borrowing more to also get out of your debt is a very slippery slope and fraught with danger. So it's best to be, avoided at all costs, and that is with no pun intended either. But those are some of the aspects that you need to really do to maintain your position and maintain your saving goals and home ownership aspirations. Okay, so you're on top of your budget, you're putting money aside fairly easily, but you're dissatisfied with, your cash attracting a relatively low rate in the bank. So if you have a long-term time frame, there are a couple of options that you could perhaps consider. Long-term is the key because you won't see results overnight and markets will fluctuate. So by having time on your side, perhaps you could look at some alternative investment structures, one of which could be a managed fund. Basically, a managed fund is a pool of money that is managed by an investment or a fund manager. The fund manager will then invest in shares, cash, property, and other assets on your behalf. A management fee will be charged, and the value will rise and fall depending on the underlying asset values. Income will be generated, which you can choose to take or to reinvest. So one of the pros of this is that they certainly offer a lot of diversification and access to a wide investment base for, a small initial investment, which potentially minimizes your risk. One of the cons that are associated with this is that if you are relying on your fund manager's skills, and there's going to be fees and charges that will also apply, which could potentially eat away at future profits. Another investment that you could consider would be direct equities, which is shares. Now, having shares is basically like having direct ownership of the company, albeit only a very small proportion. Stocks, shares, equities, they're all the same, just known by different names. These can be great long-term investments, but you'll be much more exposed to the volatility of the trading market. One of the pros of shares is that, there's income, there's growth potential. And as a share owner of the business, you're directly invested into the fortune. So if business is doing good, you'll receive good dividends and also increases in the share value. One of the cons of owning shares is that prices fluctuate, and they fluctuate a lot. And, sometimes they can trend down towards zero. The main downside is the risk that is associated or the risk that you would be exposed to through market fluctuations. Index funds. Now, these are similar to managed funds in that you can buy a series of assets that mirror an index, be it industrial or gold or iron, banking, or whatever that may be, or the ASX 200 index fund could also be a choice. So a pro is that there is an element of diversification as you're investing in multiple businesses in the index. Therefore, the risk is going to be spread. One of the cons is that there's not a huge amount of index funds in terms of options that are available in which to invest, particularly in comparison to managed funds, for example. You could look at doing a term deposit. Now, a term deposit is a simple form of investment that will generally attract a higher rate of interest than your day-to-day account because it's held for a term. The predetermined term could vary from 1 month to over 5 years. The pro is that it's really low risk and fixed interest returns are going to be guaranteed for that term that you lock it in for. One of the cons associated is that accessing your money during that term period could well be difficult, and penalties could also apply if you break the term. Now, with any investment, there are risks involved. Markets will always fluctuate, and the best strategy and the one that should be pursued is the one that's well researched and thoroughly discussed with professionals who can help you to determine whether it's going to be the best for your unique set of circumstances.